Gold saw sharp swings last week, starting strong as prices surged above $3,400 per ounce, driven by geopolitical uncertainty and safe haven demand. By midweek, gold hit a high of $3,409, but momentum faded after the Federal Reserve held interest rates steady on June 20th. This decision, while expected, cooled hopes for quick rate cuts and pressured gold lower. By Friday, futures opened at $3,387.10, marking a clear reversal from earlier optimism. The week ended with gold stabilizing near $3,360, but sentiment had turned cautious. The inability to hold above $3,400 was a technical setback, signaling sellers were gaining control. A stronger dollar and easing geopolitical tensions added to the bearish tone. Gold posted a second consecutive weekly loss, shifting the market's focus from safe haven demand to macroeconomic fundamentals. As the week closed, traders were left watching both global headlines and economic data for clues on gold's next move. The stage is set for a pivotal week ahead with uncertainty dominating the outlook. To forecast gold's direction for June 23, 27, traders turn to technical analysis. Three key tools guide the outlook: Fibonacci retracement, MACD, and the stochastic oscillator. Fibonacci retracement highlights likely support and resistance zones after big price swings. MACD tracks momentum shifts, bullish when its line crosses above the signal, bearish when it falls below. The stochastic oscillator measures if gold is overbought or oversold, flagging potential reversals. Readings above 80 suggest a pullback is likely, below 20 hints at a possible rebound. Used together, these indicators cut through market noise and clarify the trend. For the coming week, they'll be crucial in mapping gold's next move. Let's break down what these tools reveal for the days ahead. Applying Fibonacci retracement to gold's recent swing from $3,200 to $3,409, we identify key battlegrounds. First support sits at $3,322. 23.6% retracement. Holding here suggests buyers remain active. Deeper support lies at $3,308 and $3,280. Breaks below these signal sellers in control and risk a drop toward $3,200. On the upside, resistance starts at $3,360, where gold stabilized last week. Further hurdles are $3,382 and the major $3,400 level. Reclaiming $3,400 would revive bullish momentum. Failure to do so keeps the outlook cautious. Traders will watch these levels closely to gauge the next trend. The MACD is flashing a warning. Its bearish crossover signals negative momentum for gold. Sellers have the upper hand unless gold rebounds above key resistance like $3,360. Meanwhile, the stochastic oscillator has plunged into oversold territory after the recent sell-off. This hints at a possible short-term bounce, but it's not a buy signal on its own. Persistent oversold readings can mean continued weakness. For a true reversal, the stochastic must climb out of oversold and MACD must turn bullish. Until then, rallies may be brief and sellers remain in control. Combining fundamentals and technicals, the outlook for gold is cautiously bearish for June 23, 27. Easing geopolitical risks and a strong stock market have reduced gold's safe haven appeal. The Fed's steady rates and a firm dollar add to the pressure. The PCE inflation report on June 27 could further shape sentiment. Low inflation may weigh on gold. Technically, resistance at $3,360 and $3,382 is likely to cap rebounds. Failure to break through could trigger more selling. Key support sits at $3,322 and $3,300. Breaks below these open the door to deeper losses. Unless gold can reclaim $3,360, the path of least resistance is lower, though a short-term bounce from oversold conditions is possible. Traders should stay alert for sudden shifts, but the bias remains negative for now.